Greetings, welcome back. I hope everyone is having a great summer. This is our June market commentary video series. The month of June is almost over, and it has been a pretty good month despite all the noise and issues with the economy and geopolitical risks and perceived frothiness of the market. We've bounced back. The bull market officially started the first week of June. The bear market officially ended roughly around the same time. And we are going to unpack 2023 within the context of previous bull markets and bear markets. We're going to look at 95 years of data showing consecutive up years for the S&P 500 and consecutive down years for the S&P 500. We'll check in on sentiment. We'll check in on the real estate market, which is something that we haven't done for a few months, both on the commercial and residential side. So I hope you enjoy this. I'm going to share my screen. Let's get started. By the way, this video is being recorded on June 27th. So if you see something this Thursday or Sunday and it's a little out of date, that's why. It takes time for compliance to read this and scrub it and all of those necessary things. So let's share my screen. I'm going to move my face so compliance can see the source, and off we go. So this chart's a little noisy. If it's small, you can blow your screen up. But what this is, it's every bear market for the S&P 500 since 1929. All right. So every cycle we start with the earliest, so 1929, going all the way down the page until we reach the last bear market, which again reached its bottom, knock on wood, on October 12th of 2022. Of course, markets started to get difficult on 1/3/22, and you can see that here. So from the beginning of 22 to the fall of 22, the S&P from peak to trough was down 25.5%, lasting a period of 282 days. What's interesting about this is we can look at every bear market over the last 95 plus years and see how 22's bear market stacks up with the average. And on average, a bear market achieves a drawdown of negative 35% and lasts for about 286 days. So as we've covered in previous blogs, the length of this 2022 bear was very similar to previous cycles. However, the depth of drawdown was a tad more shallow, about 10%. So not quite as dramatic on the downside, but very similar in length. And when you adjust, like I do a lot of analysis post World War II, because I think our economy was becoming more mature. A more mature economy experiences less economic swings, less dramatic market swings. And I think that shows up in the data, where if you look at pre-World War II, some of these numbers are bigger, they're more dramatic on the downside. As you look post-World War II, they become more shallow with a few large crooked numbers that are sprinkled in. Now let's look at bull markets. So same set of data. We're looking at every bull market since 1929 at the top, going all the way down at the bottom in fall of 22, as of middle of June of 23's close. Now, I should have said this in the last slide, but a bull or bear market is defined by a gain or loss of 20%. There's nothing sacred about that. There's just a mental shortcut someone came up with. So if markets decline by 20%, that's technically a bear market. If markets go up by 20%, that's technically a bull market. So technically, we hit a bull market around the middle of June, actually a little bit earlier, because this is plus 24%. So I believe it was the first week of June. So from the fall of 22, first week of June, markets went up 20%, and technically that is a new bull market. Now, a lot of people aren't convinced. Investors still feel somewhat bad, although less bad, as we'll see here in future slides. But the takeaway is that the average bull market going back to 1929 sees a gain of about 114% and lasts over 1,000 days. So when you're comparing empirical data, bear markets are much shorter. The losses become shallower as the economy has matured, versus bull markets, which are much more dramatic on the upside and last for a longer period of time. Now, I'm not saying this is what happens next. This is just empirical data. And I think when you're looking at roughly 100 years of data, you can come to the conclusion that bull markets go farther on the upside, last longer. And in general, this might sound aloof or obvious, stocks want to go up. Stock markets want to go up. That's their bias. And I think, a lot of people are fearful of what comes next. I seem to get articles and YouTube videos people send me about how stocks are going to fall by 80%. That's just not grounded in reality. So I know it's mental gymnastics. It's probably entertaining. It's thought-provoking to go down rabbit holes and think things are going to blow up and get worse, which they certainly could. But again, that's just not rooted in reality. And, I've said this before, but people can say whatever they want. And narrative investing has become a thing where I can get on CNBC if I have a YouTube channel or a podcast, and I can say outlandish things because I'm trying to drive traffic to monetize my social media channels. Like, that's a real business model for many people. And if you don't understand that, if you don't have an information filter, you can get sucked down rabbit holes. You can make emotional decisions. You can do things that aren't rooted in reality, and it can become destructive behavior. So in general, when you look at history, roughly 70% of the time, markets are going to go up. Roughly 20% of the time, markets are going to go down. And roughly 10% of the time, things are going to get squirrely. Things are going to get weird. Now, if I went on Bloomberg and said that, people would look at me like I'm an idiot, like I'm adult, like I am aloof to the risks out there. I come off as unsophisticated, maybe even lazy. But if I say the U.S. banking system is going to collapse, if, and I say the dollar is going to implode, and if I say the economy is going to tank and the markets are going to go down by 80%, a lot of people find that interesting. It comes off as sophisticated. You're going to want to lean in and hear more. I come off like I'm trying to help you. That's part of the game that these folks are playing. And what we do at Pure is bring people back to the center, to refocus them, to get them focused on the things they can control and show market history and evidence. And again, we don't make predictions. We don't have narratives, but it's our job to help people think clear, to think better, to make better investment decisions. So enough about that. So this is a chart that I like that my partner Toby sent me. And what this is, again, going back about 100 years, is consecutive up years for the S&P, which are marked by the green bars, and consecutive down years for the S&P, which are marked by these black bars. So how this reads, approaching the Great Depression in the 20s and 30s, each time you see a black bar, that is a negative year. And in the late 20s and early 30s, there was 4 consecutive years of S&P losses. Late 30s, early 40s, there was 3 consecutive years of S&P losses. And then fast forward to the early 2000s during the tech bubble, there was 3 consecutive years of S&P losses. What sticks out to me in this graph is how infrequent consecutive years of losses are for U.S. large cap stocks. Conversely, consecutive positive years are much more common. It's at about a 3-to-1 ratio. For every 3 up years, we get a down year. And you can go through this and it pretty much rhymes. Now, it's not all like that, but on average, 3 up years for every 1 down year, with the occasional cluster of negative years. But for market bears, I think this should be sobering. Like, for market bears that perpetually think things are going to get worse, or are constantly market timing and going to all cash because they think stocks are going to fall, like, you're fighting a pretty powerful current. History's not riddled with market bears and their hot takes about how things get worse enjoying investment success. It's just not. And again, I come off as aloof, or I think things are going to get better, or that I'm bullish and I'm a cheerleader. I'm really not. I don't have hot takes. I don't know what the market does next. Nobody does. But I am a fan of history and evidence. And this is overpowering evidence that markets, stocks generally want to go up. You can enjoy this if you can keep your emotions and behavior in check. And part of that good behavior is educating yourself in market history and looking at your past behaviors during difficult markets and having an information filter and being very intentional about the things that you read and the people that you talk to and the social media that you consume, because it all comes at us in a fire hose of information. And if you're consuming everything, you're going to be paralyzed, you're going to be confused, and you're probably going to make some bad decisions. Okay, so enough about that. The bear market ended. It ended in June of 2023, June 8th of 2023 to be exact. So that marked the end of the 20% bull market threshold reach, right? So we experienced the bear, 25% on the way down. We ascended and reached that 20% on the upside from bottom to market close on 6/8 of 23. So the bear market is technically officially over, okay? What this is tracking every bear market end since 1947 and tracking future S&P performance for the next month, 3 months, 6 months, and 1 year. And again, I'm not saying this is going to happen. This is not a promise of what comes next. This is just evidence. And historically, once the bear market ends, the next 6 months and 1 year returns are pretty good. And that's this column here. All right. Now, there are exceptions. So the late, call it 80s, early 2000s. Again, this coincided with the tech bubble. And then a year later, you can see when the tech bubble burst, that still was painful. But overwhelmingly, most of these instances are positive. Okay. And when we aggregate after the bear market ends, average performance for 6 months to a year, you see almost 10% for 6 months, almost 16% 1 year later after the bear market ends, with a frequency of positive returns for 6 months, about 71% of the time, 86% of the time positive for 1 year later after the bear market ends. So this is pretty powerful stuff. I'm not saying this is going to happen, but if you're fighting 80 years of market data or 70 years of market data, you might be disappointed if you're shorting the market or if you're sitting in all cash. Now, there's a lot of hot recession talk, meaning everybody thinks a recession is going to happen. Well, technically, and no one talks about this, technically we entered a recession the first part of 2022. So the official definition, or a widely accepted definition of a recession, is back-to-back quarters of negative GDP. Okay, the economy shrinking for back-to-back quarters. We got that first quarter of 22, the second quarter of 22. All right. After that happens, two consecutive quarters of negative GDP going back to 1953. Again, we're tracking future S&P 500 performance from that benchmark for the next 3 months, 6 months, and next year. And again, future S&P returns overwhelmingly positive after you get an official recession. Now, the government doesn't have to call it. The government's historically terrible at calling recessions. But sticking to the definition of back-to-back negative quarters of GDP, then tracking S&P performance for the next 3, 6, and 12 months. Oops, sorry about that. Future performance is overwhelmingly positive. And I've said this before too. The market doesn't wait for a recession call and then go down. The market doesn't wait for the end of recession call and go up. The market is sniffing this stuff out. And I shared a graph in my last blog that showed the stock market basically is the perfect forecaster. It has a great track record of calling recessions and going down and sniffing out the end of a recession and going up. Now, the government is arbitrarily calling recessions, and historically, when the government calls a recession, markets have already gone down. So that doesn't help you. It doesn't do any good if the government calls a recession and the stock market is already down by 25%. Conversely, markets usually go up by 20, 30, 40%, and the government calls an end of a recession. So if you're looking at the economy, if you're looking at economic data, that's the equivalent of looking in the rear view mirror while driving, right? You're getting nothing about what happens next. Conversely, the equity markets are looking forward while driving. So picture someone driving, looking forward, checking out the road for hazards or obstacles or a better way to get to their destination. That's what the equity markets are doing. So people get confused when the economy's in shambles and markets are going up. They don't have to move in concert. It's not uncommon for them to become disjointed. So you have to make that separation. The economy and markets often become disjointed and speak different languages, and that confuses people. And I've also stated that the simple fact that everyone is predicting recession makes it inherently less risky. As we've seen over the last 3 years, what derails markets are almost never what people are talking about. No one saw a global pandemic coming. No one saw a war breaking out. No one saw a banking crisis the first quarter of this year. Okay, so what people are talking about doesn't necessarily derail us. The fact that it's widely known makes it inherently less risky. Okay, digging into some of the market dynamics this year, it's no secret that the S&P 500 has been driven by a handful of stocks. So big tech companies are really propelling this market higher. What's interesting about this is tech got crushed last year, right? No one really was talking about technology. A lot of these stocks, the Teslas, the Amazons, the Googles were down 30, 40, 50, even 60%. People were shunning them. They were selling their positions. And it turns out that's often the time to start dabbling. Conversely, on the other end, people were shoveling money into energy stocks. It was really the only place to hide last year. Well, lo and behold, and this is not uncommon, that the laggards, big tech, are the leaders this year. What was popular last year, big oil stocks and energy stocks, are getting crushed this year. And what happens is investors tend to pile money into the best performing asset classes. So last year was energy, people piling money into it. This year, those people are disappointed. Last year, people shunning tech stocks. This year, they're piling money into tech stocks again. Wouldn't surprise me if we get a correction and tech stocks end up trailing, or at least coming back down to earth. So be wary of the human propensity to chase performance. There's a saying in our business that flows tend to follow performance, meaning performance is good, investors will pile into those asset classes. I just had a client send me a text saying, hey, I want to buy an AI ETF, right? And I said, hey, buying AI might be fine, but the time to buy it is not when it's up 100% and everybody's talking about it. The time to buy AI was when no one wanted to own it last year. Unfortunately, most investors do the complete opposite of what they should do. If it's obvious in investing, it's usually obviously wrong. Let's look at sentiment. Big fan of sentiment. I've covered it on this video series before. And lo and behold, people are feeling less bad. For a long time, many investors thought things would get worse. And this is an almost perfect contrarian indicator. And I've highlighted a couple of important data points to bring that point home. So this is bearish sentiment. The blue line is bearish sentiment. As this line goes up, that means more people think things are going to get worse. As this blue line goes down, that means people are more optimistic. There's less folks that think things are going to get worse. And then the S&P 500 is the red line. All right. So let's look back at mid 21, early 21. Everybody was bullish. 21 was a great year for every asset class, stocks included, crypto, real estate, everything went up. People felt great. Bearish sentiment hit the cycle low. S&P hit the cycle high, right? What happened after that is very predictable. Markets tanked. So when people say there's no risk here, full steam ahead, I'm going to reach for yield, I'm going to reach for risk, I'm going to speculate, I'm going to take on leverage, markets usually don't do well in that environment. And the S&P tanked in 2022. Okay. Now, after the market tanked, people felt bad. So humans react to markets, right? Markets are down, people feel bad. You can see it here. S&P goes down. We hit the cycle high in bearish sentiment, meaning many people were feeling bad, thought things would get worse. What did the market do? It went up. Okay. So when everybody from your friends to your family to social media to yourself even feel that things are going to get worse, they usually get better. And that's happened in 2023 thus far. So the markets bounce back. Predictably, people are feeling less bad now because markets are up. It's a cycle as old as time. And I've said this before, every cycle is different. The cause of a market decline is different with each cycle. Human behavior, the rational human mind, is very predictable. That's why we like sentiment so much. And this is part of our rules. I talk a lot about using our rules to add risk or pare back risk in client portfolios. Sentiment is one of our favorite indicators, and it's almost batting 1,000. So again, if it's comfortable, if it's obvious, it's probably wrong. When your friends are making money hand over fist and think it's easy money to buy Tesla or Google, that's probably should be a warning sign. Conversely, if everyone in your social circle is telling you how things get worse, that also could be a signal to potentially put cash to work or get more aggressive. This is not advice, but this is just the ebb and flow of irrational human behavior. And on that note, so back to my comment, if it's obvious, it's obviously wrong. So back on February 22 of this year, the 12-month U.S. Treasury bill yield closed above 5%. And that was a big deal. It hadn't closed above 5% for over 20 years. Now there was a safe place to generate a reasonable return on cash. And many investors were saying, why would I invest in the stock market, which has gone crazy, had a very difficult year in 2022, a lot of uncertainty now in early 2023, when I can get 5% over a 1-year U.S. Treasury bill taking virtually zero risk. And that was a rational thought, okay? So if you had cash in your bank, if you had cash you were saving up for a down payment on a house, or you just like to have a certain amount of cash in your bank account, that was a rational trade to optimize your cash and get that yield that hadn't been around for a decade plus. But what we saw was people taking long-term monies that usually would have gone in their long-term investment portfolio, shoveling it into U.S. Treasuries, or selling stocks, shoveling it into U.S. Treasuries. And I wrote a blog about right here that it felt like pseudo market timing. It felt like an emotional knee-jerk reaction. And since this blog that I wrote, markets have gone up. Since the Treasury, the 1-year U.S. Treasury yield in February closed above 5%, we can see the returns for each of these asset classes. Treasury bills have been very steady. They've gone up 1.5%, so that includes any potential appreciation and the bond interest income. But look at what the S&P has done. You know, a lot of people feel good about parking cash and making that decision, and they feel like that was a rational decision for them. But there's a cost for every decision. And in hindsight, this turned out to be a horrible decision. Now, again, I'm not saying, you know, if you were nervous about markets and couldn't sleep and you were invested incorrectly, that you can't allocate some money to cash. But again, peak money market yields usually coincide with pretty good future stock returns. And I included that in my blog post. And if you want to check that out, I wrote that in the middle of May, I believe. And conversely, when money market fund flows go way down and people are shoveling money in the equity markets, usually that's a potential sign of trouble where markets could eventually go down because the herd can be wrong. And again, going back to my bearish chart, when people are thinking there's easy money to be made in the stock market, it's usually a good time to exercise caution. When people think things are going to get worse, it's usually a good time to embrace risk. Okay, let's pivot to real estate. And so this is from Redfin, and this is basically the number of homes for sale drops to a record low in May. So people simply aren't listing their homes for sale. And most of you probably know why, where a lot of people have a 3% mortgage. They don't want to sell their house, buy another house, and lock in a 7% mortgage. So people are unwilling to trade a 3% mortgage for a 7% mortgage. That makes a lot of sense. But the result is there's not a lot of inventory out there. There's not a lot of transactions out there, which means if there's not a lot of transactions, then prices really can't adjust down or up. And they basically stayed flat. They've gone down a little bit, but not the dramatic move that a lot of people are calling for. And this is a chart that supports my last comment, where 9 in 10 mortgage holders have a mortgage rate below 6%. Okay. So green is a rate below 3%. This teal, the mortgage rate's between 3 and 4%. This is 4 and 5%, and this is 5 and 6%. So you can see almost 90% of borrowers have a mortgage rate below 6%, which means they're more likely to stand pat. They might want to sell their house. They might have taken another job across the country, let's say, but they can't do anything about it because no one wants to double their mortgage payment or increase their mortgage payment by 50%. And I know there's a lot of smart people calling for an adjustment down in home prices. This is my personal opinion. I think once rates go down, if the Fed cuts rates and mortgage rates go down, that's when you could potentially see home prices adjust down, because there'll be a rush of sellers looking to unwind, and they're willing to make that trade of going from a 3% mortgage to a 4% mortgage, because that's much more reasonable. So usually when mortgage rates go down, home prices go up because you can afford more house for your dollar. This cycle's a little bit different. I think it could be the opposite. Mortgage rates go down, there's pent-up selling pressure that's released, people sell, home prices adjust down, it becomes a buyer's market. And I'm not calling for a catastrophic decline, but I think that could be a potential catalyst to home prices adjusting to an economic reality that's seen prices in commercial real estate go down. It's seen equity prices go down. It's seen cryptocurrency prices go down. So housing is not immune to the economic cycle. I personally feel that the Fed potentially cutting rates could be that catalyst. Let's look at commercial real estate. I know there's been a lot of talk about this space, what it means for banks, what it means for downtowns, what it means for commercial real estate property, specifically office property. There's been some high profile wiping of the hands, a borrower just turning in the keys and saying, I'm done with this property. I can't make the payments. I don't want to make the payments. I can't fill the building. It's worth a lot less. And I think that shows up here, where this essentially is current office building occupancy by these metro areas as a percentage of pre-pandemic occupancy. Okay. So you can see post-pandemic, a lot of these cities are struggling to get their tenants, to get their office workers back in the office. It's gotten a little better, but it's nowhere close to where we were pre-pandemic. And of course, when this happens, companies change their behavior. They're less willing to rent space. They're less willing to keep their leases. So this is a potential problem. And there's a lot of commercial real estate loans that are coming due for refinance in the coming years. And if your loan is up here, if the loan amount's up here and the property value is worth 60% less, that could potentially cause some stress in the banking system. But what people aren't really talking about is, one, office space, potential problems in office space are widely known. And a lot of these institutional investors that own commercial property are very sophisticated. And they're not going to just sit on their hands and take the loss. A lot of them are going to repurpose into warehouse space or multifamily housing space. So I don't think it's as dire as most people predict, but it does have the potential to stress banks with large exposure to commercial real estate. And then the other factor is, a lot of companies are starting to understand that working from home is not ideal. And they're telling their folks, hey, we would like you back in the office. And some are even going as far as saying, if you want to keep your job, you need to be back in the office. Maybe not 5 days a week, but 3-4 days a week. So, I think as we come out of the pandemic, our behavior is going to normalize, and the future of work could be a hybrid solution where we're in the office a few days a week and we're working from home a few days a week. Now, a lot of people are scared of REITs, real estate investment trust, and they lump real estate all together. And unbeknownst to them, there's many different styles of real estate. And actually, downtown office space, mall space, retail, brick and mortar makes up a smaller percentage of these big real estate ETFs and funds than most people understand. Now, if you went back to the 80s, those asset classes that I just talked about are a much bigger part of these REIT indexes. But the modern REIT is full of residential housing, multifamily housing, data centers, cell phone towers, storage units. The modern REIT doesn't have an egregious amount of exposure to a lot of these old economy, old school properties. So what this graph is designed to do is to show that not all REITs are created equal. The residential REIT space is actually held in quite well over the past year or so. downtown office REITs have been crushed, but data centers, storage units, cell phone towers have all held up reasonably well. So don't be scared of REITs. They pay income, they own tangible assets, they've been a pretty good inflation hedge. In our opinion, they should be part of a diversified portfolio. So I kind of powered through the final couple slides of that. If you want to go back and listen or pause, I would encourage you to do that. If you have any feedback or questions, send us a note at insight@pureportfolios.com. Thanks for watching. Thanks for listening. I'll see you next time.